I am going to talk about how I like to help people get a whole life insurance policy when they want a whole life insurance policy because of the cash value. We'll talk about 3 steps with whole life insurance, and this will really involve including it in someone's overall plan. The 3 steps we will discuss are as follows. First, saving and growing your money. This has to do with the cash value of a whole life insurance policy. Second, using your money before retirement. So while you are still working, how do you use that cash value? We'll look at that exactly. We'll look at some demonstrations as well. And then third, using your money in retirement. This has to do with taking income from the cash value. We'll talk about the tax-free benefit as well. So we're going to base today's video on someone's situation that is a real situation. They recently reached out to us. We are going to call this individual Joe Cool. And the reason why is because I really like Snoopy, and this is a mug my wife got me a couple years back for our anniversary, and I absolutely love it. Her and I both really like Snoopy. So we've got Joe here. He is 44 years old. He's interested in getting a whole life insurance policy, specifically to maximize the cash value. Now, here's what he said regarding how much he wants to pay into the policy. He said, I could do a lump sum upfront of approximately $50,000 to $60,000, but then I could also fund the policy with $25,000 to $50,000 per year. I'm not sure how long I want to keep putting premium in. That means he's not sure how long he wants to keep funding the policy, but he also says, and I would like some premium flexibility. That's a really important piece that we'll talk about. First, I'd like to use the policy for life purchases, such as buying cars, updating my home, and education. He's likely talking about Junior's education there, his kids. But then second, he'd like to use it for retirement income further down the line. So we are going to look at setting up a policy to do exactly that, everything he had mentioned. First, I just want to hit on this question. Why whole life insurance? If this is new to you, a question that you might be asking yourself, I would ask this if I'm new to it, why would anyone say, I want to put 50 grand per year into a life insurance policy? Here's the reason why. It always has to do with the cash value. The cash value is a safe place to put money that can be accessed like a personal line of credit and has a really nice tax benefit. If you do everything right, you can access that cash value tax-free anytime, and it's very easy to do everything right. So let's get on into it. Let's start with what I like to do regarding the funding. Now, when someone reaches out and provides this information, I do want to ask a couple questions just to clarify. So Joe had mentioned I could do a lump sum upfront of approximately $50,000 to $60,000, and I could fund the policy with $25,000 to $50,000 per year. So my question is this. Is the lump sum of $50,000 to $60,000 the total first year payment, meaning you want to start with a lump sum and then begin adding $25,000 to $50,000 the second year? Or do you want to fund 25 to 50K and start with an additional 50 grand on top of that, which would make the first year actually $100,000? Joe's case, the total first year, he wants to fund $100,000. Beginning the second year, we're going to look at $25,000 per year. Now, this was actually a recommendation that I made, or this would be a recommendation I would make. And the reason why is starting conservatively regarding how much we're funding the policy with is nice because Joe plans on using the policy. He plans on taking loans, and I am a fan of saving some cash flow to dedicate toward the loans. Now, with that said, this is Joe's policy. He can do whatever he wants. I'm here to really help coach him through and make sure we maximize the values, but it's set up where he can easily add 50K per year. And we're going to look at examples of that too. So some years you can add up to 50. Some years it might be 25. Some years it might just be the minimum. It's very flexible there. So it's not as if he is locked into 25K forever. Next, how long would you like to fund the policy? 5 years? 10 years? 20 years? As long as possible forever? Or I don't know. And I'll say this, most people don't know. When they first start to learn about whole life insurance, they don't know, and that's okay. Joe didn't know. Do you remember what he said? I'm not sure how long I want to keep paying a premium. That is a perfectly sound question, or that's a perfectly fine thing to say. And I'll always ask and let the person know too, it's okay if you don't know. Because as we look at different options, that will help you decide. So regarding the policy setup, this is what I think is the most important piece. This is where a lot of people have buyer's remorse with whole life insurance when the goal is cash value. So in order to maximize the cash value, the insurance premium and expenses should be minimized. What that means when I say minimized is we want to set the insurance premium as low as the insurance company will allow us to based on the policy we're purchasing, meaning how much money we're paying in. So without getting into the weeds of this, which I do far too often, how do I know if my policy is set up right? How much is Joe paying in the first year? 100 grand total. Okay. So if you're Joe, your money, the 100 grand, that's money going into the policy. That's going into your policy for cash value. Your money can go toward either the base premium in red or the PUA rider. PUA stands for paid up additions. I like to call it a cash dump in. Base premium dollars will first prioritize your life insurance benefit and then cash value second. Whereas PUA dollars first prioritize cash value and then life insurance second. So which one gives you more cash value? The PUA rider. Now here's a question we hear sometimes. My dad asked me this when I was a young boy learning about life insurance early on in my career. He said, can I just put all of my money into the PUA rider? The answer was and still is no. However, what I did not ask for him back then, and I would ask for him today, is how low can you go? Meaning how low can we set that base premium? And the answer is it depends on the insurance company. So all companies and products have specific rules, but with that said, if you're looking at any of the four major mutual companies, which are Mass Mutual, Guardian, New York Life, and Northwestern Mutual, you'll find that it's very close to a 10% minimum. So what that means, 10% minimum, is if you're Joe and you're starting with 100 grand, $10,000 is 10% of 100,000. That's your base premium. Then 90,000 can go toward your PUA rider. Now, if you're funding 10,000 per year, it'd be the same thing, a $1,000 base premium. Now, we do need a little bit of money to go toward what is called a term insurance rider, but that's a small cost. My point is minimize the base premium, maximize the PUA rider. If I pay more toward the base premium, I will have less cash value, especially when I look at the guaranteed cash values and especially upfront. What I would recommend is always just to follow the numbers. Try not to fall for this. A high base premium is better for you long term. I've seen and heard so many things in the years of doing this used as sales tactics to try and get people to buy policies with higher base premiums. I've heard things such as the base premium is the foundation of the life insurance policy, or the base premium results in the long-term compounding of a policy. I think that all of that is total garbage. Like when you look at an actual life insurance policy, not an illustration, but an actual policy that has lived the test of time, we've seen low base premiums result in more cash value. Higher base premiums every single time also result in higher commissions. So that is good to be aware of just when you're considering a policy. So in almost every case, we'll recommend a minimum base premium because it gives you the most money in cash value. And again, especially when we look at the guarantees. Also, it copies what corporations do. So if we just want to follow the model that has worked for a long time, which is what do the wealthy do and what do corporations do that have cash value life insurance on their balance sheet, I would follow the money there. So policy options. What are we going to look at for Joe? Because Joe, again, interested in what? The 100K lump sum and then 25K per year thereafter. One of the major mutual companies, yes, I would always recommend that. In his case, we're going to look at Mass Mutual and Guardian. Reason why, they offer a lot of flexibility, which I really, really like, so we're not obligated or locked into a premium. So quick overview here. Mass Mutual requires that the premium and PUA be paid at the same time. Now, I can adjust my PUA one time per year, every year, without underwriting, provided we set the policy up that way from the beginning. But that adjustment can only occur when my premium is due. So if my premium is due on January 1st of each year, that's when I can adjust the total dollar amount I pay in, or the PUA dollar amount. If I said, I just want to be able to randomly throw another 25 grand into this policy, can I do it with Mass Mutual? The answer is no, or I might have to go through underwriting first, which is kind of a pain. Guardian, on the other hand, is extremely flexible. They'll allow me to commit just to the minimum premium. I can pay that yearly, or even break it up over 12 months. And then whenever I want, I can just throw extra money into the policy at my leisure. So if I've got that policy that we looked at earlier with 100K, that's how much I'm starting with. Say my minimum is 10K. I can commit to that, pay that one time a year, or break it up over 12 months and have it set up on automatic drafts. I could just log into my online account or use my mobile app and add money to PUAs whenever I want. Extremely flexible there. So some different products here that I'd recommend to Joe, because this is the most important piece, getting the initial policy set up right. If it's not set up right, this is where people have buyer's remorse. Mass Mutual 10-pay. Why is it called a 10-pay? That means you can pay into it for a maximum of 10 years. The benefit to this policy is when you compare it with other Mass Mutual products, strong long-term performance. However, a drawback is I can only pay for 10 years. Some people want the option to pay longer and they don't want to have to get another policy. That's where this might not be a fit. So let's take a look here at the 10-pay policy. We've got illustrations for the different products I'm going to look at, which normally will walk you through these. In this video, I'm going to use a simplified version. So here's the desired funding, 100K in the first year, and then 25K per year thereafter. Here's what we're going to look at. First, what's my minimum? So he wants to start with 100K in the first year. He's going to do that. So annual outlay, 100K. Where's his money going? We see the minimum, 11K. Now, the true minimum is $10,000. That's the base premium. We have a term insurance rider attached, which prevents what's called a MEC, which is a taxable event. Without getting into the details, when we add everything to the policy, the actual minimum comes out to about 11K. But then the rest is shoveled into the PUA rider, and there's your first year cash value. After the first year lump sum, we're assuming he only pays the minimum, so he doesn't add anything extra. What is highlighted in yellow is when he gets his money back. Year 5, which is pretty good considering he's only paying the minimum beginning year 2. And it gets better if he adds more. So here's an example of what he will likely do. 100 in the first year, 25K per year thereafter. Look at the break even. Now all of a sudden, it's between years 4 and 5. This is the exact same policy, by the way. The only difference is he's adding more into PUAs with this. He doesn't have to choose to do one from the get-go. Then, what if he does 50 per year? What if he really adds some more money? Well, now it looks even better. Break even is so close to year 4. He's maximizing the cash value growth, which is exactly what he wants. So 10-pay, very strong policy. Next, we've got the high early cash value product. This is a nice option with Mass Mutual if you want the ability to feed that policy for a long period of time. So he can stop after 10 or 20 years, but if he says, I want to go for 30 years or 40 years, he could. He can pay up until age 85. That's the cutoff for this product. So the advantage, I can keep plowing money into cash value. The drawback is that the performance, the cash value growth, or the returns are not as attractive as a 10-pay. I'm going to show you what the actual returns are on a yearly basis side by side. But let's take a look here. Let's demonstrate the fact that you can fund for a long period of time. Let's start out with what he's leaning toward. 100K in the first year, 25K per year through year 10. What if he did that and then said, can I go longer? Yeah, you can go for another year. What if you went for another 10 years, total of 20? There you go. What about longer than that? For 30 years. You'll notice through the 10th year, everything's identical because it's the exact same policy. The only difference is we're choosing to continue to fund it longer. And we can adjust the dollar amount too. So we've got a lot of flexibility here, which is nice. So that's the high early cash value policy. And then we've got the Guardian L95 policy. This guy is the most popular product among the individuals we work with. So a couple reasons why. The flexible PUA rider. Guardian in general, that PUA flexibility, a lot of people like that. The idea that they're not committed to a premium every year or can only adjust it one time per year. They're committed to a minimum premium. It gives high early cash value, great guaranteed cash values. It is fantastic for someone with a large lump sum. You'll see that he can have a lower minimum premium than what he can have with MassMutual in this particular case. And you also have what's called an indexed rider available, which allows your cash value to be tied to the S&P 500 index, gives you a little bit more upside on the cash value growth in terms of potential. If I do use it, there is a fee though, so I do want to be aware of that. But it's a nice option to add because if I never use it, there's no fees. So a lot of times people attach it just in case they want to use it. The drawback, however, is I can only aggressively fund typically for about 20 years max. If I want to go longer than that, I can still pay my premium and a little bit into PUAs, but I can't keep on adding 10 times the minimum premium or something like that. Has to do with how the term rider works and such. But if he wants to go for 30 years, that high early cash value policy is likely going to be a better option. So I'll let you know which one I would recommend. But first, let's look at a couple demonstrations of the Guardian policy. And again, these will all be the same policy. So pretend you're Joe. You don't know what you want to pay in. Let's start with this. What's your minimum? $6,000 per year. That's the true minimum with the base premium. Base premium is $5,000 with this option. Term rider and such attached, $6,000 per year. That's what you pay, that or $500 per month. First year, you do a total of $100,000. So it's your $6,000 minimum plus $94,000 in PUAs. First year cash value, $92,000. Then after that, in addition to your minimum, you add another $19,000 in PUAs for a total of $25,000 per year. Breaking even, almost year 3. All right. Here we go. $50,000 per year, but only through year 10. So sometimes we'll see a case like this. Someone will say, I want to be able to fund this for 20 years. But what if I pay it up early? I'm going to pay more into it, but stop in a shorter period of time. Can I do that? Yes, you can. And look at that. Almost breaking even year 3. You can tell I like this stuff a little too much. I'm a strange nerd when it comes to life insurance. And you can call me that if we ever have a conversation. I promise it will be interesting. And then here's what it looks like if he funds for a short period of time. If he says, I want to stop early, which he can do too. So pretty cool when we look at it. Let's take a look at a side-by-side of those options. And first, let's compare the MassMutual options. Now, we mentioned that the 10-pay policy produces more cash value. It's got the strongest performance. Look at year 20. There's the gap, about $80,000. And as time passes, like if you look at age 70, you're at $920,000 compared to $792,000. Like that gap is widening. Same company, same dividend rate, different products. The 10-pay policy is designed more for strong long-term cash accumulation. That is that product, like when you look at it. So MassMutual to MassMutual, 10-pay is typically going to have the highest growth rate. Now looking at Guardian, here we've got the exact same product, but the dividend rate on the left, and then demonstrating that indexed rider on the right. So with the indexed rider, you will see greater long-term potential because it's based on market history. That is all hypothetical. That is something we like to talk about, but some people really like that feature. Even if they never use it, they like to attach it just to have it in case there's a big market correction like 2008. And if there's a long rebound, I can flip that indexed rider on and experience the upside for a while, which is nice. And then lastly, if you like returns, here we go. So this is the annual ROR, rate of return, which if you said, what did I earn last year? This percentage would answer that question. If you said, what did I earn since starting the policy? This percentage would not answer your question. In that case, I would request the internal rate of return, which a lot of times we add to Excel. You can also see it on an illustration. If we add it, here we go. That shows the lifetime performance of a life insurance policy. And all of these are based on the non-guaranteed values. We can easily run the guaranteed values as well. A lot of times we will do that. It's quite simple. All we do is add a report. We'll drop it on Excel. But it looks just like this under the guaranteed values. Let's continue on, shall we? Okay. So, growing the policy, or I should say, which one would I recommend here? And then we'll get into step 2, using the policy. Number 1, I'd recommend the Guardian L95. And I would recommend this specifically if he expresses that he really likes that flexibility. If he says, I love the fact that I can commit to $6,000 a year, I can pay it at $500 a month, that never feels like a burden. Like, I'm never going to be stressed out or worried that I'm going to have to come up with this premium. If we have that conversation, that's where Guardian's nice. Also, if he says, yeah, I don't think I'm going to fund it for 20 years, or not aggressively. I'm going to go aggressive for 10, maybe 15 years. That's where Guardian's going to work really nicely for him. Now, if he says, I don't need that flexibility. Like, I've got money in cash and I'm very disciplined, and I like the idea of funding for 10 years or less, that Mass 10 pay is going to look good. You saw the numbers. It was quite attractive. And then if he says, I think I want to go for a long time, talking 25, 30 years, that higherly cash value product, we can do a lot of damage in a good way with that option. So let's assume he picks option B. That's the one he goes with. And he's going to go with $100K in the first year and then $25K per year through year 10. Why I'm running with that assumption is because we're going to look at step 2. What was step 2? Using the money for retirement. Ready to have some fun? Oh, no, using the money before retirement, not for retirement. So what we're going to do is use the policy for cars, home updates, and education. Let's demonstrate this. So using your policy for this stuff, cars, home updates, why I would use it for a car is if I don't want to purchase in cash, typically what I'll do is what? If I don't have a life insurance policy, I'll finance it with a bank. So in this case, we're going to finance it with our life insurance policy. So my first question is, when would you like to buy your new car? His answer, 1 to 2 years from now. What kind of car are you looking to get? Looking to get a nice SUV for me and the kids. It's going to run me about $50,000, Steve. All right. You're getting a good one. Do you want to repay that loan? Yes, absolutely, because I want to use this policy for retirement. Okay. How much would you like to pay it back with? Because you can do whatever you'd like when you look at these loans. $10K per year. I'm comfortable doing that. Okay. So let's see what that would look like. We're going to look at the Mass Mutual 10-pay policy. First year, 100K goes in. There's his cash value. To the right, we've got the example. We're going to take loans and then repay it. All right. Year 2, we take a loan. What happens? Before, cash value 113, death benefit 1391. After a $50,000 loan, there's your cash value, there's your death benefit. What happened to your death benefit? Dropped exactly dollar for dollar. The cash value dropped as well. That's the equity that you have access to. The maximum amount you can borrow is what you have in cash value. Then he repays it at $10K per year. Just want to look at this. Cash value and death benefit. Notice anything? They're exactly the same. So your money stayed at work for you all the way through. What I would look at, if you're really focused on the numbers, is this guy. So of your $10K per year payment, purple is how much went toward the principal, and light red is how much went toward the loan interest. You can look at how much you paid in interest compared to how much you got in interest from the insurance company. Some people like to do that, including myself. We've got a workbook that allows people to do that. Let's look at another loan, shall we? So here we're going to look at a home improvement. When? Probably 10 years, because he wants to move his parents in. How much? $250,000. He wants to repay it. Doesn't know the number. What he says is, I want to pay it back in 10 years by the time I retire. Okay. There's a $250K loan. What do you notice? Before loan. The death benefit dropped because we did that deliberately. You don't have to. The reason why is because when he's not paying into it anymore, a lot of times what we'll do is drop the death benefit so our cash value grows at a faster rate. That's the reason why. But it's optional. It's $1 million drop. Not everybody's comfortable with that. So here's this $250K loan. Follow my arrow. 152. Your cash value, again, is the equity. Think of it as your line of credit if you're familiar with real estate or have experience there. Death benefit, again, drops dollar for dollar compared to the non-loaned example. All right. Now he begins to repay it. $40K per year. Light blue is what he pays. Purple is what's applied to the principal. Red, applied to the loan interest. So you can see exactly where your money's going toward that loan. Then you see your loan balance coming down. Okay. Now, far right, cash value and death benefit being restored just like a line of credit. Cash value, 612. Death benefit, 878. Exactly the same at that point in time. This is where people like to use these policies. The money continues to earn interest. So when you take a loan, you keep earning dividends on your full bucket of cash value, not just the remaining loan balance, or not just the remaining cash value, I'm sorry. So our money keeps on compounding all the way through. That's a big, big point of attraction with these policies. And an item I did skip over, my apologies, is when you request a loan, you typically get it in 2 to 5 business days. You can do it right through your online account. You don't have to be approved or apply for it like a traditional loan. We've got the word loan with life insurance policies because of the tax benefits. You don't have to pay income tax on loans. That's why people like them. And then for the kids' education, he got a free ride. If we wanted to model a loan, we would do the exact same thing we did with the car loan and home improvement. So let's wrap this up with taking income from the policy. So he wants to take income at either age 65, 70, or 75. So this is really easy to do. And also the income is going to be tax-free. So let's start at age 65. 64 technically. I messed up the numbers here. So he's going to take $35K per year. And light blue is the total dollar amount he got from his policy. Now remember, he paid in $325. So first, when I'm looking at how much I got, I want to make sure I take that into consideration to say, okay, the first $325, I'm just getting my money back. But then after that, that's the gains. So am I getting more than what I paid in? The answer is yes, and a whole lot more. And we're assuming he kicks the bucket in his 90s in this example. But he gets a total of $1,050,000 out, which is nice. Let's see if he takes income at 70. How much can he pull per year? $48K per year. That's $4,000 a month. We see the total amount is more. Typically, if you defer taking income from a life insurance policy, you'll end up with more money. And again, the tax benefit is why people are attracted to this. When corporations do this, like this is a huge reason why, when they're taking income on the back end and then paying their retired executives, like those disbursements, you do it right, tax-free. And the death benefit flows back to them tax-free too. That's the corporate model. But you can set the same thing up within a family. Anyway, here we go. Deferring until age 75. Look at that. Boom, 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 boom. Total income, $1.4 million. If you'd like to see these models, let us know. You can email us, whatever you prefer. If you're already working with us, we'll send them to you, no problem. But that's the income model there. Pretty simple. Now, one thing I'll add here too, part of the overall plan, especially when we're looking at retirement, at times will consider an annuity. And this can work well, but it's not for everyone. Where it can work well is if someone has an old 401k, or maybe they've got some money in savings, and the purpose of those dollars is for retirement. They don't want to take on any risks. They don't want to deal with a money manager. Maybe they're already doing that, and they say, it would be nice if I could just use this income in retirement without having to worry about running out of money. Here's what some people do. They move a chunk of change, maybe it's an old 401k, into an annuity, and they've got guaranteed income in retirement. That word right there is what's attractive to a lot of people, guaranteed. Really what you're doing is buying insurance for your money. Someone said that once. I'm like, I really like the way that sounds. And that's exactly what you're doing. You're ensuring that you're not going to run out of money. So you could give an insurance company $100,000, and then if you take income 10, 20, or 30 years down the road, you'll see that you're guaranteed $3,000 or $4,000 per month. Could be more or less. It depends on when you start the income and such, but it's guaranteed. That's the nice feature. So it can be a nice option to supplement income in retirement if I like the guaranteed feature. And again, it's not always a fit. So to summarize the overall plan, Joe is interested in what? Funding a life insurance policy for life insurance? No, to build the cash value. He does get life insurance with the plan too. So if he dies, his family is protected. He can use his cash value to buy a new car, to build an addition on his home, and do whatever he wants with. You don't have to qualify or specify the reason why you're taking loans. In retirement, he can take income, and guess what? It's tax-free if he does everything right. And then he can also supplement his guaranteed income with an annuity if that is a fit for him. So I hope you enjoyed this video. I had a ton of fun putting this one together. I would love to hear your thoughts and if you have any questions at all. And if you do have questions on the policy setup, because that's usually where people do have questions as far as making sure the policy is maximized for cash value, you can check it out. You can check out this video here. This provides just a demonstration of how we'll take a basic policy and then design it for maximum cash value. So again, I hope this helps. Thanks so much for watching all the way through. We'll talk to you soon. Thanks again.